Good afternoon, everyone. This is COM 220. My name is Oye Abioye. It's going to be a 6 weeks program, mid-session. So we'll be making twice a week, every 3 hours, Mondays and Wednesdays. We'll be looking at COM 220. And before we start, this is the textbook we'll be using. This is the Corporate Finance Fundamentals by Ross. Is the 9th edition. And for this course, all we need is a calculator. It's a Sharp EL738. It's very good, and I recommend you strongly, you have one for the class. So today we're looking at the first chapter, which is looking at Introduction to Corporate Finance. And just to give you a head start to look at an outline of what the chapter will look like. These are the respective chapter we'll be looking at. First, look at the concept and the key skills that the chapter will look at, which will look at the basic financial management decisions and also some of the roles of the financial manager. So that'll be the first one to look at. Equally, we'll be looking at the financial implication of the different forms of business organization. So what are some of these forms of business organization? We'll look at that. The three main ones we have in Canada. Equally, we know some of the goals of financial management, typically, which is to basically increase shareholders' wealth. And then we understand some of the conflicts of interest that can arise, okay, between the owners of a company and the managers or the management of this organization. Owners want something, the managers want something else. And so because of disparity in the demand, excuse me, the demand of what each of the stakeholders wanted, that create a conflict. And so we're looking at some of these different conflicts of interest between the two parties. We also look at the types of financial market and also look at the financial institutions that are out there. And finally, we'll look at the trends in the financial market. So in a nutshell, the chapter outline will look at the corporate finance and the financial manager. We also look at the forms of business organizations, also look at the goals of the financial management, and also look at the agency problems and how do we control the corporation, so which we call the corporate governance. We look at the financial markets and the corporations, and look at the financial institutions and the trends in the financial market and financial management. So in a nutshell, that's what the chapter will look at for this one. Okay, so the next is now to go into the chapter. And the first thing we'll ask ourselves is, what are these pertinent things that companies or corporations are trying to achieve? And part of it is to look at these questions, which will involve looking at some of the long-term investment a firm will want to undertake. Why are we looking at this? The reason is because we want to evaluate all the respective opportunities that the companies have, and as such, which of this investment will be the one that will give them the best or the optimum results. As such, we look at long-term investment a company will want to undertake. So that's the first thing. So having identified this long-term investment, we also need to consider where is this fund, this investment be the source of funds to fund or to execute this long-term project. As such, we look at this question, which has to do with how do we pay for this investment that we've been able to identify. The reason being that we have limited resources, and of course, we also have different forms of financing that can be tapped into. So which one gives us the optimum results in terms of achieving our optimum goal of increasing shareholders' wealth? And the third question, which a corporate finance will want to also ask, will be, how do we manage every day-to-day operating resources, i.e., the working capital management, which are things that the company needs on a daily basis to enhance the achievement of the long-term goal. So these are the three main pertinent questions that corporate finance will look into. And as such, this project or these particular functions or role relies solely on the financial manager. And as such, financial questions which we try to answer all these questions as the best as possible, because without having a right answer to all these questions would typically lead to a failure of an organization. And if you don't want to result into failure, then definitely the three questions asked must be answered as best as possible to achieve the best results. As such, now we need to also look at the responsibilities in terms of the hierarchy of the financial management. And as such, at the top of the hierarchy, we have the chief financial officer, who is the overall boss of that department that looks into the whole spectrum of how financial management function operates within an organization. And below the chief financial officer, we have the treasury or the treasurer. The treasurer, of course, oversees the cash management, the capital expenditure, and also financial planning of an organization. That's directly below the chief financial officer. And below him, we also have the controller. The controller looks at the taxes or the cost accounting, financial accounting, and also data processing of the organization. So these are all the other aspects which has to do with cost management and also data collection and data processing, which relates to financial management of an organization. So, having done with all this, the next thing to now look at would be to identify some of the financial management decisions, as which looked earlier. So, which identify the three aspects that we asked earlier, part of which we call the capital budget. The capital budget, as we said earlier, we'll be looking at what long-term investment or project should the business undertake. As I said earlier, the reason for this is because we have limited resources and we have several of the goals, from different stakeholders, i.e., the shareholders on one hand, who want a lot of profit and as such dividend from the investment they put into the organization. On the other hand, we have the management that probably can be identified or can be defined as an employee. So they also want their, they want their salary, they want employment, longevity. They also have, all the resources, all the perks that the corporation can offer. And as such, these two different objectives or goals has to be satisfied fully in order for the organization to achieve the corporate goal. And as such, the capital budget will look at all this. Okay. And the next one would now be to also look at the corporate structure. Corporate structure or capital structure look at how do we pay for all these investment that we want to embark upon. So how do we pay for it? And again, companies have two options, really. The main one, which includes sourcing funds through debt financing, i.e. Borrowing money. We can do bond. Bond is one main, or you can look for long-term loan, which a company can access. If not that, then we can talk about equity. With equity, it means shareholders typically, or owners, are the ones that will fund the long-term project. So we call that equity. So those are the two main forms. And as such, why do we call it capital structure? Well, capital structure simply identify in what proportion do we want to have the debt and the equity, in what proportion. So the proportion typically identify or is what we identify as the capital structure. And the third decisions the financial management will also make will have to do with the working capital management, as we talked earlier. So which means how do we manage the day-to-day financing of the firm? So all these three are the main key decisions that financial management will have to find an optimum solutions or results or outcome, which will also revolve in terms of how do we achieve the corporate goal or the long-term goals of an organization. So basically, these are decisions that financial management must make. So having done that, then let's also consider the forms of business organization we have in Canada. The first one is looking at, we have three main ones. The first one is called the sole proprietorship, which means one person running the business. That's the first one. We'll look into it in more detail later on. We also have the partnership, which can also have the general and the limited. And then the third one, of course, is the corporation. Corporation meaning a company that is funded through equities. Okay, and also we call that it can also be called the joint stock companies or public limited companies or limited liability companies. The whole idea is the fact that the liabilities of owners, shareholders, is limited to the amount invested in the company initially. So now let's go into looking at each of the forms on one-by-one basis. So the first one we talk about is called the sole proprietorship. Again, the business is owned by one individual, okay, and it's run, as easy as possible from the, you can even start from your bedroom, okay. No particular regulation is required in this one, as long as you run it, and it's a business venture which is legitimate. The advantage of this form of business is the fact that because it's one person owning it, therefore it's pretty easy to start. Okay, as long as you have a business venture in mind and you have a business. So one of it is that it's easy to start. That's the first one. Equally, it's least regulated, so which means there's no particular government regulation which regulates the operation of this organization, the form of organization. And the third advantage is the fact that the single owner keeps all the profit because he does not share any activity with anyone. He or she bears the entire profit or earn the entire profit the company generates. And the fourth benefit is the fact that tax is paid once, which means again, the reason behind it is because there's no separation between the owner running the business and the profit that the business itself present at the end of the year, and as such. So the business income is the individual income as well, and as such, any tax that's applicable is paid by individual. So in essence, business income here is taxed as an income tax regime. So which means there's no separation between the company and the individual. So one tax regime operates with this form of business organization. On the other hand, let's look at the disadvantages of this form of business. One of it is the fact that it has unlimited liability. Unlimited liability in the sense that because the owner is responsible for the business, so any damages or any liability that comes up, that person will be fully responsible for it, including using his or her own personal belongings to pay for the liability incurred by the organization. So we call it unlimited liability, as far as using personal property to pay for those debts. The next one is called the limited life of the owner. So what that means is the fact that the life of the individual is tied 100% to the business, to the organization, and as such. If he leaves, business leaves. If he dies, business dies. So because the life of the business is actually tied to the life of the owner, that's why it's called limited life, as compared with other form of business that we'll be looking at later on. Equally, equity of capital is limited to owner's personal wealth. So how much company is able to raise is fully dependent on the owner's ability to raise funds. So i.e., personal wealth will play a big role in the financial position of the organization. And equally, the last one is the fact that it's very difficult to sell the interests of this company because, first and foremost, valuing the asset or valuing the business can be very difficult, and as such, it's very, very difficult to sell the ownership interest to a third party if need be. So that's the sole proprietorship. The next form of business that we're talking about, which is a little better than sole proprietorship, is the partnership. Partnership, by definition, is a business that exists. It's between two or more individuals carrying on business with one motive, which is to make profit. And when I say profit is simply the residue between the revenue and the expense. And I've seen people asking, why are you in business? They say, because of money. Not really. You're in business because of the profit. Okay? So the advantage of this partnership above the sole proprietorship, the first one we looked at earlier, is the fact that, because there are two or more individuals come in, so two or more individuals come in means they have more people that will run the business. So that gives strength to the organization and also the capability and also what the company can equally do. Equally, more humans, more financial capability, that's the meaning. So which means individual going out there, to raise, to pool funds. That means companies able to raise more money. Equally, with that of the first, which is the sole proprietorship, it's pretty easy to start as well. So relatively easy, not too much regulation as compared with the limited liability company they'll be looking at later on. Another advantage of this partnership is the fact that the tax regime is equally relatively related to that of the sole proprietorship. So individual partner pay the income tax once. So the business income is partner's income. So because they share the income of the company on a profit, the established profit sharing ratio. So individual pays their income, the taxes on the income shared from the organization. Now let's look at the disadvantage of this particular form of business. One of it is the fact that there is unlimited liability. Unlimited liability, so which means all the members will be fully liable to the liabilities of the organization. However, there are two conditions here. We have limited partnership. Limited partnership simply means those partnership which end with LLP, so which means it protects the other partners who may not be part of or who may not be involved with the executive or management of the organization. However, we have a general partner who bears the liability of all the partner. So it's unlimited liability. But however, because of these divisions, we have the general partner, we have the limited partner. General partner bears all liability, whereas the limited partnership will only be limited to the amount of contribution into the partnership agreement. Equally, the partnership dissolves when one partner dies or wishes to leave. So in essence, it's not just death that can dissolve partnership. Moreover, the fact that the partnership is a contract between two or more, when there is a change in the constitution of that partnership, typically brings the partnership to an end. So an entry, or which means an admission of a new partner, will change the profit sharing ratio, and as such, it automatically dissolve the partnership. Likewise, an exit of a partner will equally distort the profit share ratio, and as such, it will dissolve the partnership. So, partnership dissolve when there's an exit or an entry of new partner. Equally, the partner is difficult to transfer because same as that of the sole proprietorship, the problem that we see has to do with the valuation, business valuation, which makes it difficult. And also, possible disagreement between partners can also be another impediment which can bring about a dissolution to this partnership. Other ones is the fact that it's also limited life. It has a limited life, so which means the life of the partnership is also dependent on whether there's a dissolution, through admission or exit of a new partner. So it has a limited life in that respect. So that's the information regarding partnership. Now, those are the first two. Now let's look at the third one and see which one will be better suited to anyone interested in, set up a business venture. So we have a corporation. The corporation, as we know, is a business created as a direct or which is distinct with a legal entity owned by one or more individuals or entities. So what are we talking about here? As a corporation, we see it as an artificial person or entity. Now, when we say artificial in the sense that it first and foremost, it bears its own name, and usually the name ends with the word limited or PLC, which means Public Limited Liability Company, or INC, which is incorporated. So these are the respective ways to define different forms of corporation. We have private, which is a private limited company, which are called the limited one, and we have the public, which is called the Public Limited Liability Company. The INC is applicable to both private and larger organizations. Now, when we say legal entity, so it means that once a company is incorporated, it's distinct from the owners. And as such, first, it bears its own name. It does, or it carry on business in its own name. So, and as such, it can sue individual and it can be sued as well. So, sued and be sued in its own name. It carries everything, all the activities done is done in its own name. And as such, we call it a corporate organization. Okay? So what are the advantages of this form of business? The first one is first that it's limited liability. Limited liability in the sense that the liability that this corporation can ever owe is dependent on the subscription by the owners. And when we say owners, we mean the shareholders of this organization. So, the company get incorporated. We have funds that's subscribed through purchase or sale of shares of this corporation to individuals, and they become shareholders. So the liability as such that this corporation can therefore owe is dependent on the total amount of contribution from the shareholders, which we call the equity shareholders. So we call that limited liability. Equally, it has an unlimited life. Why is it unlimited? Unlimited in the sense that share of this company is transferable as opposed to the first two business organizations which do not have, their interests cannot be transferred. So it transfers from 1 year to the other. It transfers from one owner to the other indefinitely. And so that's why we say it has unlimited life. Equally, there's a separation between the owners and management. Okay, so the ownership are the shareholders, and then the management are the employees. And as such, we have something we call the principal and the agent relationship. Okay, so the owners, they provide the funds to run the business, whereas the management, they run the business, and they provide something we call stewardship to shareholders or the owners on the yearly basis, which is represented through financial statement that's presented to the members or the shareholders in an annual general meeting called AGM, at which point financial statements are tabled before the shareholders. So these are one of the advantages. Equally, transfer of ownership is pretty easy. You can find someone, you can advertise it, you can go through secondary market to sell on the shareholding of this particular organization. So it's pretty easy to transfer ownership. Okay, and finally, raising capital for this corporation too is pretty easy. You can do the IPO, which is the initial public offer, which can be done through the stock exchange. We have different stock exchange, TSX, Toronto Stock Exchange, and different exchanges across the world. These are places where, or the platform where shares are typically sold. So having said all this, these are all the advantages, good fun, the good stuff. What about the bad stuff, which are the disadvantages of a corporation? Well, the first one is the fact that there's separation of management and ownership. And so what is this, why is it a disadvantage? Well, it's a disadvantage in the sense that we're looking at two separate stakeholders. So stakeholder being people who have an interest in an organization. So ownership, the owner, for example, that's one stakeholder. Management, on the other hand, that's another stakeholder. Because of the separation between the two, that create conflict. The owner, for example, probably wants an increase in profit. And how do you have an increase in profit? Well, increase in profit by reducing your cost. If you reduce the cost, revenue goes up, profit goes up. That way, they can get a good cut, for their investment through dividend payment. On the other hand, management, they also want to, have a good chunk of the revenue generated by the company through salaries. And as such, there's an increase in cost, which goes directly in conflict with the goal of the owners. And as such, there's conflict of interest. So this is a big disadvantage to this organization because of the conflict of interest. On the other hand, we also have another problem with this form of business, which includes double taxation. Double taxation in the sense that taxes or dividends are paid from after-tax profit. And as such, company pays corporation tax, and whatever it's remaining, which we say that's the net income. Based on the net income, then they declare the dividend based on whatever it's remaining. So already they've paid the corporation tax at whatever percentage of rate of the tax. Now, the shareholder that received this money is also, in their hand, is seen as an income to them. And so they also pay income tax. So because of that, we have a tax, double taxation, from this revenue coming from the corporation. So basically, although there are other ways that one cannot mitigate against reducing the tax burden as a result of this dividend through tax different tax credits that's available to owners of this of the shareholders. All right. So there are other information that we can find on the internet which can help in terms of startups, which I will just leave you to look through all those. Now, let's look at some of the goals of the of financial management. The first goal, therefore, would be what should be the goal of a corporation? Well, one of it is typically one of the reasons why owners want manager to run the business is first maximize the profit. So that is one main goal of financial manager. Okay, increase the profits. The next one is to minimize costs. Minimize costs. So the first one is actually in the best interest of shareholders, whereas the minimized costs would be detriment to management. Okay, because by minimizing costs, typically it will erode on their earning capacity. So which means their salary too will be affected by minimizing that. Equally, maximizing the market share. So they also want to maximize the shareholders' wealth by maximizing the market price of the share. So market share will be one goal of the financial management. Equally, we need to maximize the current value of the stocks. So the price is what this one is targeting. So by doing everything ethically right, we're able to achieve all this. However, one question which one then asks is, does it mean that we have to do anything, and everything to maximize shareholders' wealth? That's the key question here, which has to do with ethics, which has to do with ethics. And as such, let's look at these goals in detail. So first and foremost, we look at the maximizing the shareholders' wealth. We look at the maximizing the share price. We also look at the maximizing the share firm's value. So this is the primary goal of an agency. So because of that, it leads to one problem, which we call the agency problem. And when we say agency problem, what does that mean? Well, agency problem simply means the relationship between the owner and the principal. The owner and the principal. The owner would be the shareholders of the organization, and of course, the principal would be the management. And as such, what are these problems? So the first start is the principal hires an agent to represent their interests. So the owners, shareholders, they hire the management to carry out these business activities in their best interest. And as such, we say the stockholders are the principal, and they hire the manager, which are the management to run the organization. So what is the problem therefore? Well, the problem is the difference in the interest of the two stakeholders. So look at the owners on one side. We also look at the management on the other hand. Each of them will have their own respective goal. And because the two may not be incongruent, that leads to agency problem. What is it? So part of the problem is the fact that the management wants high revenue in terms of salary, and also the benefit, employee benefits. The shareholder, on the other hand, they want increase in dividend. So these are the main problem which create a conflict. And so what are these agency costs? The first one would be the direct agency costs, which has to do with increase in costs through employment increase, or indirect, or different forms whereby classic conflict of interest would be commission, employee not willing to abide by the rules of the game, i.e., whatever the stakeholder want, they may not be able to provide that. So these are all some of the things which can create a lot of problems, which can be costly around the organization. So how do you manage all this? How do you manage it? Well, part of it is to bring about and create an incentive that can align management interests with that of the stakeholders. So aligning, these particular goals would be a better way. So i.e., the incentive need to be structured carefully to make sure that they achieve the overall goal of both parties, i.e., the owners and the management. So i.e., the principal and the agent. So by aligning the two, it bring about goal congruence, and that will enhance the achievement of the overall goals. So in going that, we also look at how do we control the organization. So part of it would be the threat of a takeover, which may result in better management. Okay, so other ones which we also have would be conflict with other stakeholders, which has to be resolved, amicably in order for the overall company to achieve the goal of increasing shareholders' wealth. Okay. Other area of this chapter, we now look at the social responsibility and ethical investing. Okay. I want to talk about social responsibility. This is typically part of what the society actually demands. So, for example, investors are increasingly demanding that corporation behave responsibly, which is forgiven. Okay, and one of the reasons is the fact that the corporation is seen as an entity that lives within an environment, and as such is artificial, and as such their activities hinders the community in general, and as such, if they want to remain in that community, they have to behave in such a way that other members of the committee or community will be in the best interest of their general living. And as such, they have to do everything which will enhance good living within the community. So that's one good way. Example would be funding local charity, funding clubs within the environment, and paying for vacation, just support the community. That's one way. Equally, issues include how corporation treats the community in which it operates. So, i.e., the customers, corporate governance, the employees, the environment, and also the human rights by not hiring illegal immigrants as opposed to hiring the local employees or local people in their organization. Equally, we also look at the controversial business activities such as the alcohol, gaming, genetic engineering, nuclear power, pornography, tobacco, weapon. These are all some of the problems that it requires corporation to actually operate in an ethical manner, also in a way that it will be seen to contribute to social welfare or social well-being, living within the community. Okay. Other areas which we'll also look at would be what is the role of financial markets in the corporate finance? Well, part of it is the fact that cash flows to and from the firms, which is what the financial market will also look at. So the financial market, for example, act as obtaining the funds and making available to people who need the fund. So cash flows to and also from to the firm as well. So they act in both ways. Equally, we also look at the money versus capital market. The money market would be the short term that deals in something like the GIC, which is the Guaranteed Investment Certificate, or the Treasury bills, versus the capital market that does in long-term investment. So they deal in that kind of investment activity. Equally, we look at the primary versus secondary. The primary is looking at such as the first time when the shares of the organization is sold on the stock market, so called through the IPO, which is the initial public offer. Okay, and so once the shares are out there, and then transferring to subsequent shareholders will be through secondary market or through dealers. Okay, so we're looking at that. Other ones we'll look at would be one excellent site for this would be to go through the TMX. Okay, where you can get more information on that area. So when we say cash flow to and from the firm, what do we mean? Here we are. So we have the total value of the firm, okay, which we call the fixed assets, firm's fixed assets on the left-hand side, and then we have the total value of the firm to investors in the financial markets. So we shows the financial market, and as such, the firm issues securities, okay, to the firm, okay, and from there, cash is received, which is given to the firm. That's C. It goes to to the company, and part of it is gone through government through paying of taxes and stuff, and then from there it goes to the market where that money will be made available for short-term debt financing, long-term financing, or it can be equity financing, and as such, that money is reinvented back into the firm, and so the circulation continue. So that way, it's not in one hand, but it circulates. By the time it goes back and forth, it generates more revenue and it increases in value. So that's what they do there. With the financial institutions, what they do is they act as an intermediary between the supplier of this fund and the users of this fund. So the supplier will probably be from individual, and the user will be to the corporation. So buying shares is one way of raising funds. So the individual provide cash for the certificates of the company, and then the fund is transferred to the company that sells the shares. So that way, the firm, financial institution, they act as an intermediary. Or you can talk about the loans. So an individual has a loan with cash, and then they put it in the bank. They call it savings. and that's the source. And then individual companies come in and then borrow money, and that becomes a loan, which can be short-term or long-term. So that's the way. So differentials act as an intermediary in between the two. So is your earned income on service provided through indirect finance, such as the interest that's earned, on the spread between the loans and the deposits. So the loan with the company and the deposit loan they give out, and also the deposit received from the investors. And also we have the direct finance, which are the direct response to the particular activity provided, such as service fees, such as the bank acceptance, and also the stamp duties or the stamping fees. So these are some of the charges for the services provided by the financial institutions. Now let's look at the trend in the financial markets and management. One of these financial re-engineering, today we now see changes in how financial markets are operated. Now, part of financial engineering will look at the way and manner financial institutions go about selling the stock. Back in the days, you go to the stock exchange hall, and then it's like a card. But today you can do electronic buying and selling of stocks. So it's revolutionized. It's really make much more easier to do. We also have the derivative securities. By the word derivative, mean derived from a particular. So we have like if you talk about interest, for example, it's an interest derivative. If you talk about commodity, say like the gas or oil, or you can talk about commodities such as cow, gold. These are commodities, so-called commodity derivatives. These are all securities. Okay. Equally, we will talk about the advances in technology, such as e-business that we see today. So a lot of activities are online, such as even banking, for example. We have e-banking, e-business. These are all kinds of, information or activities going on, which is the new trend in financial markets today. We also have the issue of deregulation. Deregulation simply means you have less regulation, so which means we make it much more easier to run an organization or to do business. So less regulation encourage more participants in the organization, and also encourage a lot of interest in doing business. The other one is corporate governance reform. Corporate governance is a way that organizations are managed and controlled. This is one of the new reform that came into being, which is typically targeted at corporate misbehavior as a result of the Enron situation, scandal. And as such, we have Sarbanes-Oxley 2002 as an act, which typically guide the ways and manner in which organizations are managed and controlled today. Part of what is stated in this act is the fact that there should be a separation of power between senior management, i.e., the chairman of the board will be different from the managing director and chief executives, such that there's a balance of power. In other words, if power, as stated, is considered in the hands of one individual, it gives that individual too much avenue to misbehave, and as such, corporate governance came into being and separate those two powers. Therefore, one can act as a check and balance to prevent excessive power from one individual. Other one is the hedge funds. Hedge funds, which when you say hedge is simply a way to mitigate or to reduce impact of damage or loss. So we have hedge funds available to mitigate against losses from investment. We have the subprime market. The subprime market typically the sub of the interest, particularly for those who are not able to meet the stringent credit rating for the prime rate. And as such, this is typically for those not so good credit rating, and as such, the subprime market, to target those particular market. So having said all this, typically that's the end of the chapter. And so the next chapter we'll be looking at more in depth into financial statements, which will be chapter 2. So that's it, ladies and gentlemen. Thank you.